Have you ever pondered about the ripple effects of a change in the U.S. Federal Reserve's interest rates on the stock markets? It might seem like a topic for economists and financial analysts, but understanding this relationship can offer insightful perspectives for anyone interested in the world of finance and investments. The Federal Reserve, popularly known as the Fed, is the central bank of the United States. The interest rate it sets, known as the Fed rate or the federal funds rate, is the rate at which banks lend to each other overnight. When the Fed adjusts this rate, it's like turning the knob on the faucet of the U.S. economy, either increasing or reducing the flow of money. So how does this impact the U.S. stock market? A change in the Fed rate directly influences borrowing costs across the economy. When the rate is lowered, borrowing becomes cheaper, sparking businesses and consumers to borrow and spend more. This surge in spending can supercharge corporate earnings, potentially driving stock prices up. On the flip side, when the Fed rate goes up, borrowing becomes more expensive, potentially slowing economic activity. This slowdown can squeeze corporate profits, which can pull down stock prices. Now, let's take a leap across the globe to India. How does a change in the US Fed rate affect the Indian stock market? The impact is indirect and comes through various channels. Firstly, there's the role of foreign institutional investors, or FIIs. These entities are significant players in the Indian stock market. When the Fed rate goes up, it can trigger capital outflows from emerging markets like India as investors chase higher returns in the US. This can decrease demand for Indian stocks, potentially causing stock prices to tumble. Next, we have global sentiment and risk appetite. A change in the Fed rate can sway global investor sentiment. For instance, if the Fed hikes rates due to worries about inflation or economic overheating, it may signal a tighter monetary policy environment worldwide. This can dampen investor appetite for risky assets, including stocks in emerging markets like India. Lastly, there's the impact on currency exchange rates. Changes in U.S. interest rates can influence the value of the U.S. dollar against other currencies, including the Indian rupee. A stronger dollar can make Indian exports pricier and less competitive, potentially hurting the earnings of Indian companies and, by extension, their stock prices. In conclusion, while changes in the U.S. Fed rate directly impact the U.S. economy and stock market, they can also ripple through to the Indian stock market via investor sentiment, capital flows, and currency exchange rates. The world of finance is indeed interconnected, and understanding these relationships can provide a richer and more nuanced perspective on global financial trends.